Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the descending hawk candlestick pattern. This powerful pattern serves as a key indicator of potential market reversals, particularly after an uptrend. Understanding how to identify and trade this pattern can significantly enhance your trading strategy and improve your decision making. So stay tuned until the end of this video as we will discover and cover everything to recognize this pattern effectively during your trading, and it will help you capitalize on the market movement. So let's get started. We start by understanding what this descending hawk candlestick pattern is, and it's a two candle formation that signals a potential reversal in the market. It typically appears after a strong uptrend, indicating that buyers may be losing control and sellers are starting to gain control. Now, how do we identify this pattern? We look for the first candle. The first candle in this pattern should be a long bullish candle. This indicates that buyers are in control during that period, pushing price higher. The second candle is crucial because it should be a short bearish candle that opens above the close of the first candle. It opens above the close of the first candle and closes below its body. This shows that although buyers initiated the push to the upside, sellers stepped in as quickly as possible, as you can see from this diagram over here. Understanding the context in which this pattern formed is also essential. The descending hawk should appear after a clear uptrend or a corrective rally. If you see it in such situation, it becomes a stronger signal for a potential reversal. Additionally, pay attention to the trading volume to indicate that traders are participating in the sell activity. By recognizing these elements, you can effectively spot the descending hawk pattern and prepare for potential trading opportunities. Now, let's see how we can apply this to our trading strategy. Once you have identified the descending hawk pattern, it is important for you to have a clear trading strategy in place. Here are some effective trading strategy you can use to trade this pattern. First of all, we think about the entry point. The ideal entry point for a trade based on the descending hawk pattern is below the low of the second candle. This confirms that sellers are taking control and that price is likely to continue downwards. If you decide to take the trade below the low of this descending hawk candlestick pattern, you put your stop loss, because stop loss placement is important. We manage our risks and it is crucial to set a stop loss. A good placement for your stop loss should be above the high of the first candle. So it has to be above the high of the first candle. In this way, if the market moves against you, your losses will be limited. Where do we set as targets? When it comes to setting profit targets, we should always consider support levels, previous support levels, or we can use moving averages as reference. A common approach is to always aim for a risk to reward of at least 1:2. 1:2 can be a standard risk to reward while taking this trade. This means that for every dollar you risk, you are aiming to make at least $2. That is the idea of this strategy. Now, if you bear with me, we will look for a different pattern in such a way that let's look for another trade so that we can know how to capitalize on this strategy. Now I can see a different pattern in this area. This is still called the descending hawk pattern, where the first candle is a long bullish candle, and this indicates that buyers are in control during this period, pushing price higher. And the second candle is crucial because it is a short bearish candle that opens above the close of the first candle, closes below his body. So this is a proper example of another pattern. So if I want to take the trade using this pattern, remember you take the pattern at the close of the second candle. Your stop loss should always be above the swing high. Then you target a minimum of 1:2 or 1:3 as the case may be. By following this strategy, setting a clear entry and managing your risks, you would find out that your stop loss would help you to avoid unnecessary fake out. And when you establish realistic profit targets, you would effectively trade the descending hawk pattern and increase your chances of success in the market. This is exactly what the pattern entails. If we can see, we can also spot a failed pattern. If we look at this, we can see this was almost a descending hawk when we had a bullish candle and a bearish candle that opened above the bullish candle and closed within the body of the first candle. If we decided to take this trade at this area, we would have been in profit. But one bad thing about this setup is that it wasn't in an uptrend. So that means this pattern is invalid because market was not trading in an upward direction before we decided to take this trade. So this particular trend before the reversal has invalidated this setup. So for you to consider this pattern to be a standard pattern, it has to be in a strong uptrend before you decide to take the trade. Your pattern must be spotted like you see this example I used. It is spotted in a confirmed uptrend. This was a confirmed uptrend before market decided to reverse. It was in an uptrend, as you can see. When price got to the peak of the uptrend, it formed this pattern and it gave us our reversal signal. And this is all you need to know about this strategy. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching and I will see you in the next video.